An uninspiring campaign has caught up with Theresa May and the Conservative Party and eroded their Westminster majority, possibly leaving the UK facing the prospects of a coalition government for the second time in 3 general elections, though as I say that, Mrs May is going to see the Queen with the intention of forming the next government today. Going into the June vote, markets had rather lazily been relying upon the opinion polls, which had continued to point to a Conservative win. So this unexpected development is likely to create some short-term volatility in stock, bond and particularly currency markets today. The markets were able to quickly express a view on the hung Parliament result by trading sterling overnight in Asia. The pound lost around 2% against the dollar, falling to around the 127 mark, retracing some of its recent gains. In some respects, it could have been a lot worse for sterling, and that may reflect the electorate's rejection of, or at least failure to wholly embrace, the Prime Minister's so-called hard Brexit stance. However, the pound's slide is leading to an action replay of last year's post-EU referendum trading pattern now that markets are open here in the UK. Today's early moves saw the FTSE 100 rise and the more domestically oriented FTSE 250 fall as stocks took their lead from the currency markets and the big multinationals and dollar earners moved higher. It's noticeable that defensive names such as the food, drink and pharmaceutical sectors did best in the opening exchanges today, reflecting the prevailing uncertainty. Gold and silver miners were also to the fore as well, as they are also potential beneficiaries of a weaker pound and a stronger dollar. The FTSE 100 laggards were more domestic names like banks, house builders and consumer discretionary players such as retailers and media stocks, even if talk of a softer Brexit could play to the financial services companies at some stage, assuming of course it does prove to be more than just talk. In the very short term, Theresa May's dash to reinstall herself in number 10 may calm the markets a little bit. Remember that back in 2010, the FTSE 100 fell 2.6% on the day after the election of 6th of May that also threw up a hung Parliament. The index then rallied 5.2% on the following Monday when incumbent Prime Minister Gordon Brown resigned, and overall the index recorded a gain of 2.3% from the day before the ballot to the announcement of the Liberal coalition, Democrat coalition with the Conservatives on the 12th of May. Now, in contrast, then the UK government bond or gilt market wobbled a little bit, as the yield on the 10-year benchmark gilt rose to 3.78% from 3.74%, and sterling lost between 1.5% and 2% against the dollar and the euro on May the 7th as the hung result became clear. But those losses shrank on each count against dollar and euro by the time Cameron and Clegg had cobbled together their coalition. Anyway, the scope for short-term swings is clear using 2010 as a model, but note that markets calmed down pretty quickly as economic and company fundamentals reasserted themselves. Over the 12 months following the 2010 election, the FTSE 100 rose nearly 14%, while the 10-year gilt yield fell from 3.74% to 3.4%, helped by the Bank of England's quantitative easing bond buying programme. The pound also gained 10% on the dollar and lost 4% against the euro in the year after that election. This was as much due to the fundamental backdrop as anything else, a recovery from the financial crisis and ultra-loose monetary policy from central banks the world over in the form of falling or record low interest rates and QE. British politics next to that lot meant relatively little. Fund managers certainly know that in the long term it's not politics that determine securities valuations, it's profit and cash flow that drive share and bond prices, so they shouldn't let political noise divert them from their investment strategy, at least if they're following their mandate and doing their job properly. After all, punting around on the basis of which manifesto promises will be kept or jettisoned or compromised, well, that's just a bit of a mug's game. Advisors and clients should bear this in mind as well. Perhaps the best plan is to stick to the long-term strategies already devised and implemented. Second-guessing what may or may not come out of Westminster and any talks between, say, the Tory minority and the Democratic Unionist Party, well, that's a thankless task. If nothing else, keeping calm and avoiding incurring what could be unnecessary brokerage fees and commissions, as well as other frictional costs such as dealing spreads and maybe even stamp duty and tax, is definitely the best play forwards. After all, as the American economist Robert Solow put it, economists are often asked to predict what the economy is going to do. But economic projections require predictions about what politicians are going to do, and nothing is more unpredictable. Thank you for watching, and I look forward to seeing you next time.